Maybe we can start. My name is Pierre-Alix Binet. I'm head of programs and strategic development of Finance for Tomorrow. I'm going to host a webinar this morning just to quickly remind what Finance for Tomorrow is. This is a branch of Paris Europlace to make green and sustainable finance a key driving force in the development of the Paris Financial Center and to position it as a hub of reference on these issues. Our 80 or more members represent the diversity of the finance sector, ranging from banking to insurance, including investors, consulting firms, research institutes, and brings together the public and private sectors. Finance for Tomorrow provides the players in the Paris Financial Center a platform for ongoing work and dialogues and expertise able of accelerating the transition dynamics. We work on different subjects, biodiversity, innovation in finance, climate risk, just transition, the impacts of the Green Deal and the European taxonomy, and many other subjects. We started hosting webinars at the start of the crisis. We really wanted to organize this webinar because energy is an integral part of our reflections, and because we are fortunate in Paris to have the headquarters of the International Energy Agency and many actors who position themselves on these subjects. Energy, the mother of environmental battles in particular, even more so during the COVID-19 epidemic, which created historic situations everywhere. It should be noted that 20% drop in investment in energy expected in 2020 instead of the plus 2% forecast on the basis of announcements by companies and states is indeed historic. Whole sectors will be affected, oil and gas, such as wind, solar, and electrical networks, with the biggest impact on American shale oils. The International Energy Agency is concerned about this decline. You are also worried about the 11% decline in capital invested in clean technologies, which pushes emerging countries to burn more coal and resort to obsolete technologies. You're calling for an orderly transition to a greener energy mix, so as not to destabilize the hydrocarbon producing countries or create shortage among Western consumers, and while respecting the Paris Climate Agreement, which imply an accelerated reduction of fossil fuel. So we are very curious to know more. I hand over the speaking to Michael Waldron and Simon Bennett from the IEA to present the World Energy Investment Report. And from this presentation, we'll follow a dialogue with Ladislas Smia to have the vision of an investor, and not least on this issue, Mirova. Last, these two exchanges will be followed by an interactive Q&A session at the end. So please, Michael and Simon, thank you very much.
Okay, thank you very much, Pierre-Alix. Simon and I are two of the lead authors of this World Energy Investment Report that we're going to present. And first thing I will do is try to load the report here. So hopefully everybody can see that.
Yes.
Great. So to just give you a bit of background, the World Energy Investment is a report we've published now for 5 years at the IEA. And a lot of IEA work, including publications like the World Energy Outlook, Energy Transitions Perspectives, etc., are focused on looking at the future. So focus on looking at the next decade or decades ahead to look at the evolution of the energy sector. But what the World Energy Investment does is it really tries to understand what are the trends now in terms of capital flows for investment. And normally what we're trying to do in this publication is to look at the prior year. So this year, the beginning of this year, we were going to look at 2019. Of course, the world has changed quite rapidly since the beginning of the year. And so here the focus is turned more towards what we think investment will be like in 2020. We're doing this based on the latest available data, at least the latest available data that we have access to. So trying to put a view together of energy investment across the different sectors as of mid-May in 2020. So it reflects about the first third of the year that we've seen. The structure of the report, and you can find this on the IEA website, the first parts of the report are focused on analyzing, and indeed in this presentation, analyzing capital expenditure trends in the fuel supply sector and the power sector, in energy efficiency and end use. But we also have chapters that look more deeply at some of the financing and the funding trends for energy investments, and also research and development and technology innovation trends, which we're going to touch upon towards the end of the presentation. I would just note as the last part of the introduction that the economic growth assumptions that we have associated with this 2020 view, they conform to the IMF's lower for longer economic case. So it assumes a global GDP decline this year of some 6%. And the investments here do not reflect necessarily government actions in terms of stimulus programs to spur investments. So this is something we can discuss more in the Q&A, and there's also forthcoming IEA work on this, but just to set out some of the sort of broad assumptions before we begin. As Pierre-Alix already communicated, when we were looking at the company plans, government plans, et cetera, for investment in 2020, we were expecting a 2% rise in total energy investment. So energy investment, we tally about $1.9 trillion worth of capital expenditures, and we were seeing modest growth in 2020. This may not appear significant, but because investment has actually declined every year since 2014, 2% growth was actually going to be quite impressive. But what we saw with the advent of the COVID-19 pandemic and the crisis is that 2% growth has turned into a 20% decline. So a record level expected decline in capital expenditures going into the energy sector of almost $400 billion. Much of this decline is concentrated in countries and regions with large domestic oil and gas industries. So particularly the United States, but also Russia, the Middle East, and North Africa. Of course, all regions of the world are also affected and also hit, and all sectors are affected. And we'll go through some of the transmission mechanisms and some of the details in the subsequent slides. So what is driving the cuts that we expect in capital expenditures? I would say there's kind of two broad forces at play here. The first is looking at kind of the practical disruptions to project development, to labor being able to service projects, to work on projects, the delivery of equipment, any sort of physical disruptions to supply chains. So these are very much related to the practical implications of the lockdowns and the physical restrictions we've seen in many countries around the world. But there's also kind of an economic transmission mechanism, an economic impact. And the energy investments face new risks, both from a funding standpoint, but also a financing standpoint. And the implication is that because consumers are spending a lot less on energy in 2019, and the chart on the left shows you some of the changes that we expect in some of the major sectors. The balance sheets of the major energy, of many energy companies are in a weaker state. There's greater uncertainty over demand, and there's lower prices. So all of these have combined to make a sort of more bearish outlook for energy investment in 2020. I would note that historically, and the chart on the left shows you consumer spending in energy. Historically, oil and electricity have accounted for about 90% of the spending. But what we expect in 2020 is that the revenues available for oil declined by about $1 trillion, and that for electricity declined by a lot less. But electricity typically is a lot more stable in terms of spending. So any decline that we see in 2020 is noteworthy, not just due to the price and demand issues, but sometimes due to delayed or non-payments by consumers. So the impact on this in terms of investment varies quite a bit among the different sectors. Most of the declines are concentrated in the oil and gas sector, where investment is expected to decline by a third. Power declines by only 10%. I'll get to this in a couple slides. But we also see notable reductions in spending on energy efficiency, on more efficient goods, which is due to declines or expected moderation in construction industry and transport sales or automobile sales in 2020. And we also see declines in some smaller sectors like upstream coal supply mining. In general, this is hurting not just the company balance sheets, but it's also having a knock-on effect for governments as well, who also get tax revenues from these different sectors. So in the next few slides, I'll just try to walk you through some of the sectoral detail. First, concentrating on the market for oil and gas. Normally in this presentation, we would show a slide that shows all the different companies with reductions in capital expenditures. We decided to not include that, but it just include this slide on some of the impacts for the overall market. What we're seeing is that many oil and gas companies ranging from integrated oil majors to service companies to US shale operators have cut CapEx by some 30 up to 50% or 60% in some cases. So that our initial expectation has been revised down by about a third. Now, what is the impact of this on oil markets? I think is a big question everybody would like to know, because this has implications for where prices will go. What we did is we tried to map out, and the implications are not immediate in terms of the effect on oil supply. So if you're looking at 1 year of lower investment in 2020 levels, and you're trying to understand what the impact would be several years from now, we estimate that there would be a loss of some 2 million barrels a day if the 2020 cuts were just maintained for 1 year. But if we have a situation where investment in oil and gas and upstream oil and gas is lower for several years, over the next 5 years, for example, this can imply a loss of some 9 million barrels a day. Not to necessarily say that this will happen, but it just raises this prospect of uncertainty over demand, the possibility for demand to rebound perhaps in the post-pandemic environment, and whether or not the capital spending by the oil and gas companies can keep up. And if it doesn't, then the implications are that perhaps there's room for more tightening of the market or price volatility ahead. I would say one big difference between the situation now and the situation 5 years ago when we had the downturn in oil prices is that oil and gas companies had a lot of room to cut costs, and this time their room to cut costs is much more limited. So the investment cuts are very much feeding directly into reduced activity. Now turning to the power sector, we see investment cuts which are relatively mild compared to oil and gas and the rest of fuel supply. But the power sector is at the heart of strategies for economic development and energy transition in a number of countries. So any decline in power investment is, for us, a cause for concern for energy security and sustainability reasons. What we see is in 2020, we expect about a 10% drop in power capital expenditures. What the chart on the left shows you is a comparison to 2015. And then on the right, it shows you the cumulative change from 2015 to 2020. The reason why we're showing it this way is because the expected drop in power investment in 2020 is not just the product of 1 year, but it's also several years of lagging growth that we've seen in some sectors. This is most apparent when you're looking at investment in things like coal power, which arguably for energy transition would be a good thing if you're having less investment in coal power. But this has not been met with a strong increase in investment in things like renewables and electricity grids, which are two key components of energy transition going forward. And indeed, both of these sectors would need to be growing rather than declining in order to meet energy transition goals. Now, one area that we focused on in terms of our key messages, and this is an important one for the decarbonization of the power sector, is looking at final investment decisions for coal-fired power plants. And here we look at the gigawatts. So the FIDs being taken in terms of the sizes and the capacities of the plants that would come online several years from now. And what we've seen is over time, a very dramatic reduction of FIDs in coal power plants, about 80% from 2015 to 2019. But what we see in 2020 is given us a bit of a sign for pause or a bit of a sign for warning. It's still the case that the coal power fleet continues to expand, even as the FIDs go down. So the new additions still outpace the retirements that we're seeing in a number of places around the world. And there's also a mismatch between additions and retirements. So emerging countries in Asia are still adding a lot of coal power, whereas most of the retirements are occurring in Europe, in the United States. What we saw in the first quarter of 2020 was a slight uptick in terms of approvals. So the rate at which new projects are being approved is twice that seen overall in 2019. Much of this is due to China, but it's also due to other countries in Asia. So this is a trend that we think deserves watching as we're looking into in terms of longer term trends for sustainability of the power sector. Of course, energy transition is more than just looking at the electricity sector. It's looking at other parts of clean energy, including things that we're tracking, renewables for transport and heat, so things related to biofuels for transport or solar thermal water heaters. We haven't really talked about nuclear, but nuclear we also have is an important part of energy transition related to the power sector. Energy efficiency, as well as other sort of new emerging technologies for integration and decarbonization, so battery storage and carbon capture, utilization and storage. And what we saw is that in last year's report, actually, we said that the share of spending on clean energy was stuck at about 1/3 of total energy investment. And this is the gray line that you see in the past, and this has been the case for several years. And what we said last year is that this share needed to go up to about 2/3. And what we saw in 2020 is actually the share is going up. So it's going up towards 40%. It would be quite a dramatic rise. But the reason the share is going up is by and large related to the weakness that we've seen in fossil fuel related spending and the investment in clean energy overall, even though there are some parts that are more resilient than the fossil fuel sector, is still going down. And in terms of the level of where it needs to be, remains even farther from that would be suggested by 10 years ago, 10 years from now in the IEA scenarios. So with that, I'm going to turn it over to Simon, who's going to kind of walk us through some of the pathways to sort of scaling up clean energy investment and some of the financing and technology and considerations when we're looking at the implications of these investment trends. So Simon, I'll leave it to you and I can turn the slides.
Okay, thanks, Mike, and good morning to everybody on the line today. Thanks for tuning in. Yeah, as Mike just said, we're going to look a little bit about at who's doing the investing in the energy system. So drilling down a little bit from the high-level numbers just presented into some of the investment trends. We have a section of the book, a chapter that looks at the financing and funding stories throughout the energy system. And I think it's of particular interest in the context of the COVID-19 pandemic to look at where the money is coming from, who is doing the investing, who might be coming out of the current situation in better shape or in worse shape, because that gives us some signals about who will be well placed to contribute to economic recovery and where stimulus money or other attention might need to be focused. So one of the things that we looked at this year again was who is making the investments. That means who is providing the capital, who is owning the projects. And in particular, we looked at the split between the state-owned energy investments and the private sector. By state-owned, we mean investments by state-owned enterprises, by national oil companies, but also direct investments by governments through public procurement, perhaps of energy efficiency measures. And what we find is quite stark. So firstly, it's not shown here, but the share of state-owned investments is actually declining somewhat, but it remains at around 35% globally. Now that 35% globally is really a tale of two types of economies, with the share being much, much higher in emerging economies, where it's actually around 60%. And it's particularly high in areas such as infrastructure and also in fossil fuels. In renewables and energy efficiency, there tends to be a much greater participation of private sector capital. But with advanced economies having a much lower share of state-owned energy investments, we actually think that they have a broader range of financing options when it comes to scaling up or to plugging some of the gaps in finance through the crisis. And I think it's worth noting that there's sort of an inverse correlation here. It is possible that state-owned enterprises are a good vessel for channeling money into the energy sector, but they tend, those large shares of state-owned enterprises tend not to be in the countries that have the capital firepower to be able to cope with the crisis, in some cases, in emerging economies. So Mike, if you want to move on to the next slide. Another aspect of this that we looked at is, in fact, the performance of certain parts of the energy system in terms of portfolios of equities. And one of the issues here is, of course, that as we go through the crisis, different companies are going to have weakened balance sheets. They're going to be exposed to differential costs of capital as a result of the impacts of the COVID pandemic on their business models. And that's true of companies within the energy sector, but it's also going to be an impact for companies, or there'll be an impact on energy from companies that are outside the energy sector. Some companies outside the energy sector are very important off-takers, for example, for renewable power. Other companies are proving themselves to be key in terms of investment in the new, especially digital technologies that are coming through, and investors as well out in the world of venture capital are important for helping entrepreneurs with new ideas in the energy system to scale up. So this isn't just a story of energy companies, but we have focused in particular on renewable power, sort of a portfolio of renewable power equities, and one of fossil fuel supply as well. And this is some work that we've recently undertaken with Imperial College London, where we've looked at the performance over the last 5 years, and we find a trend of renewable power returns holding up better than fossil fuel supply. And what we've shown here on the slide is the trend since January of this year, which is actually quite stark. The performance of renewables have done quite a bit better than fossil fuel supply. So, in particular, this is related to what's happening in the oil sector, but obviously, in terms of the performance of the stocks, you might expect those companies to be exposed to higher costs of capital, perhaps going forwards, and be in a different position when it comes to being able to invest once the economy begins to recover. Now, of course, renewables, they do also rely very, very heavily on government signals, and there is a certain amount of market uncertainty, and also their ability to scale up is strongly linked to the number of projects in the pipeline, and also liquidity issues as well. So it's not all plain sailing for renewables through the crisis. Okay, perhaps we'll turn to the next slide, and here we're looking a little bit again at the types of investors and some of the trends in terms of who's providing capital into the energy system. And we think it's interesting to see that institutional investors, that their contributions to energy investment have been increasing quite a bit over the last decade. So there's trebling of the level of their spending over that decade, and in particular, a lot of the growth is related to renewable power, and the reliable revenue streams that are provided by many renewable projects provide quite a healthy investment opportunity for institutional investors. But one of the things that we're highlighting here is actually that the trend is very different when you look at advanced economies and emerging economies again. So whereas we had that big difference between emerging economies and state-owned enterprises, with emerging economies dominating in that regard, when we look at institutional investors in terms of project acquisitions and refinancing, it's the inverse. So advanced economies have the financial infrastructure already in place to be able to tap into institutional investor capital in a much stronger way. Although we do see some examples of this happening in emerging economies that we might be able to talk about during the Q&A. And yeah, as well as renewables, I think it's also just worth mentioning that network infrastructure, which Mike mentioned, is something that we're really communicating a lot on this year, because we see this decline in investments in things like electricity grids as potentially storing up real problems for the energy transition, and where electricity networks are able to provide a very stable revenue stream for investors. They have been attracting institutional investor capital, but perhaps not in the volumes that you might that might lead to stronger growth in that area. Okay, if we move on to the final slide that we have around the issues of financing, we took a look at green bonds and other types of sustainable debt securities. So the labeled green bonds, the green and sustainable loans, the sustainability linked debt, And one of the reasons we wanted to bring this to your attention is just because 2019 was such a strong year for growth. So we've seen growth in all of the years that we've been tracking this, but the real increase, especially in the sustainability linked debt, we think was a very positive story in 2019. But of course, even as that grows to a market of 450 billion globally, this represents only around 5% of the debt issued globally in 2019. So it's still not a mainstream issue, but as I'm sure everybody on this call knows, there's an increasing sort of voice for the investor community in climate and sustainability issues, and sustainable debt is really become a very strong vehicle for investors to be able to link their investments directly to green and sustainable outcomes. And if we look at the chart that's on the right here, then we can see what those intended outcomes are. And energy efficiency and end use is a significant share of renewable energy as well. And one of the things that is reflected in the strong share of energy efficiency is that within that growth in green bonds, there's quite a high participation of issuers like Fannie Mae and Freddie Mac in the United States for efficiency-linked mortgages. And there's also a number of major issuances by public sector actors, such as KfW in Germany, but also the French government. And things like energy efficiency, things like small-scale renewables are particularly attractive for this type of financing, as you'll know, because it allows investors to be able to invest in sort of in grouped projects that are small scale, rather than needing to get involved in many different projects individually, which is particularly attractive. But because there's some of these large sort of government-linked actors, the Freddie Mays, the KfWs, this is perhaps a conduit for some of that stimulus money that people have been talking about, because of the direct participation of governments and the potentially the lower cost of capital coming out of the crisis in the way that central banks deal with this. There's something to be discussed there, but we have looked at the numbers for Q1 2020, and we do see a slight dip year on year in the activity around sustainable debt, as you can imagine. And so we'll be keeping our eyes on the trends as we go through to the end of the year. If we move on to the final set of data that we have to show here, we do have a section in the report that looks at research and development and energy innovation. I think the main financial linked story that we pulled out is around venture capital investment. And this is a kind of a rosy story for 2019. We've seen some big increases in what's happening in VC for clean energy, especially up to 2018, but really dominated by EVs, by mobility, and some very large deals, especially in China. So we were quite pleased to see that in 2019, although there was a very slight dip, the investment remains robust, and there was a rebalancing both geographically and in terms of the sectors that are receiving money through VCs, the startups and the entrepreneurs, which provides a particular role in the innovation landscape. But this isn't necessarily a suitable means of financing for all types of energy technology. So we look as well in the report at things like carbon capture, utilization and storage, which is generally not the type of projects that are conducive to the returns needed for venture capital. The chart on the right simply shows something that we dug into a little bit more in terms of where the money is coming from for these VCs. In the past, we've looked mostly at where the VCs themselves are headquartered. And if you look at where the money is coming from, there's big differences in terms of the markets that are reliant on internal financing. So VC investment within a country, funding startups within the same country, and those where it's a big sort of dominant role for investors from outside the country, such as Israel, India, and Australia. But in general, there seems to be more diversity of funds, more internationalization of energy VC in 2019. Now, what we see in 2020 was a reduction. So if you look at all venture capital activity, including growth equity in 2020 Q1, then there was a 50% drop. And that's to do with the more difficult deal environment, but also the policy uncertainty, the market uncertainty going forward for how quickly these companies can make returns. So we do expect that some of these elements of the innovation chain are going to be disrupted, and that's going to make it much harder for good new ideas in the sustainability area to make it to market within the 2025 time horizon. I think we've used up the time allocated to present the bits of the report that we thought that the audience here would be interested in today. There's a wealth of more information in the report itself. We've drawn out 5 particular conclusions for you, but they'll all be familiar from the presentation that Mike and I have given. So I suggest that we leave those up on the screen for a moment for people to read through them, and I'll turn it back to Pierre-Alix to chair the next section.
Pierre-Alix, you're on mute.
Thank you. Les aléas du direct. Thank you very much. Thank you for this very interesting presentation. For those of you watching, don't hesitate to ask your questions from now, and we will respond after. I hand over the speaking to Ladislas Miak, Head of Responsible Investment Research of Mirova. Thank you, Ladislas.
Well, thank you, Pierre-Alix. So, well, maybe just a word of introduction about Mirova for those who might know us very well. So we are part of the Natixis group, and we are an asset management company dedicated to responsible investment. We manage 12 billion euro. The bulk of it is invested in equity, in listed equity, about 8.5 billion. We have also investment in the fixed income areas through with approximately 2 billion to 2.4 billion asset under management, mainly on the green bond market. So this is for the listed part, and we have also non-listed activity with investment in energy transition asset, mainly renewable energy in Europe, where we manage something like 1.5 billion euro asset under management. And we have also a natural capital division where we invest in agriculture, forestry, this kind of thing, as well as a division invested in social impact in France. Regarding natural capital, it's mainly invested outside of Europe, mainly in developing countries. So that was just a brief introduction, which I think it's important to give you this kind of insight, just to give you what kind of reaction I can have on the presentation. So, well, actually, maybe the first comment I can give you is that on our side, for our equity portfolio, we have been since the beginning of Mirova, so in 2012, we are not investing at all in oil and gas, and we have tried to put a very strong focus on clean technologies, renewable energy, but not only, a lot on energy efficiency in all sectors and in energy transition as a whole. Our equity portfolio has been through the crisis with a quite significant and even very significant outperformance compared to the benchmark. Some of our portfolio, well, the outperformance, depending on the kind of portfolio, can be between 4% to 15%, so 1.5, which is kind of important. So this is especially the case for our environmental portfolios, where we invest specifically on clean technologies. So I think we can here see the link between what has been presented by Simon and Michael and what we are experiencing for our portfolio. The fact that, of course, having no oil and gas in the portfolio when you see such a downturn on oil and gas is of course helping. As you have shown in your presentation, renewable energy and clean technology has been much more resilient through the crisis than oil and gas and fossil fuel in general. So it helps quite a lot. It's not the only reason. It's also the fact that we have more, well, we do not have any airports, we do not have any, we have lower exposure to car manufacturing and this kind of thing, and we have stronger exposure to health, which has kind of outperformed a little bit on technologies also, and most of all also on clean technology. This kind of exposure has really helped us. Plus, well, stock picking is also, of course, a reason of performance, but I think it's not the place to discuss this here today. my thought about that is the idea that I think we used to see oil and gas. Well, if you look at the oil and gas prices between the 2010, 2011, and 2015, the oil price has been kind of quite stable. And since then, well, it was above $100 a barrel. And since then, we have been, well, through strong changes in the oil prices. And what appeared to be some kind of robust industry shows that we are going through strong volatility on oil and gas. So what I'm saying is that on our side, if we do not invest in oil and gas, it's mainly because of the kind of customers we are targeting are not willing to invest in this kind of thing, and this is the project of the company. I'm not saying that oil and gas is not going to, prices are not going to rise again, and that investors invested in oil and gas won't make any performance again. But my feeling is that, well, the way oil price is calculated leads naturally to a lot of volatility. And I'm afraid that the transition pathway that we are going to live, that we are already living and that we are going to live in the next decade will lead to even more volatility. And being invested in oil and gas, when you are, for instance, a passive investor and you invest, well, something like between 7, 8, 10% of your portfolio in oil and gas on the equity side, might look like a traditional investment, but actually, if you try to forecast yourself in the future a little bit, I'm not sure that it's still relevant to, even from a financial point of view, to put such an emphasis on fossil fuel due to this volatility constraint. Then, from an impact point of view, as an investor, you might be also interested to push for a more cleaner world. So sending a message through your listed investment by reducing your investment in fossil fuel. I think if you look at any IEA report, investment report for forecasting what should a 2-degree world look like in terms of investment, I think the order of magnitude is divided by 2 your investment in fossil fuel or something like that, and multiplying by 2 your investment in clean energy. Michael Simon, cut me if I say something wrong, but this is the kind of order of magnitude I have in mind. So maybe when you speak about investment, when you build your equity portfolio, I believe it's time more than ever to think about maybe it's time to stop sticking to the index in terms of sector breakdown, because the kind of sector breakdown we used to have in the past might not be what we should have in the future. And doing some index-related investment might not be the best way to invest, both from a financial materiality point of view and from an impact point of view. Maybe a word about our non-listed portfolio. So when we invest directly in a renewable energy project, this has been quite resilient also over the crisis. So of course we have been through some delays in terms of construction of project. We have phases, well, depending on the kind of project you invest in, some projects you have some feed-in tariffs, so the price of the electricity you will produce is guaranteed. On other project, for instance, in the northern of Europe, you will be connected to market prices. So you might face some risks, but actually the kind of issues we are facing is not so big. And from our perspective, investment in renewable energy is kind of resilient during this crisis, this kind of crisis. So overall, what I would say is that when we speak about a transition towards a more sustainable economy, you often see some kind of scenario showing some very smooth curve of transitions. And I'm afraid that this crisis might be one of the first crises we are facing in the 21st century. Well, we have already been through the financial crisis in 2009, but from my perspective, it's unlikely that the transition towards a more sustainable economy is going to be smooth. We will face some new crises, either due to energy issues, some pandemics, some biodiversity issues, some climate change issues, and I think it's time to rethink the way we are looking at portfolio construction. So I've already discussed this, well, how much do we want to invest in fossil fuel, but also how much do we want to invest in renewable energy and clean technologies as a whole on the equity side first, because, well, changing the way you build your portfolio is a good way to send a message to the market. But this might not be enough. I think you have shown in your presentation that investment in clean technologies is not enough at all to reach a 2-degree wall. So at Mirova, we believe that investment in equity can push a little bit the market, but this will not be enough to drive the transition. And so for investment, considering some other kind of investment in non-listed asset, directly investing in infrastructure project, is or through green bonds that you have also discussed, is a good way to bring new financials to lead this transition toward a more sustainable economy. Still, even if investors move in the right direction, if they are investors will be only one part of the equation. And well, I think that you had one statistic in your presentation explaining that investors are a quarter of a total investment for acquisition and refinancing. So of course, this change will need to be followed also by other players in the economy. But I strongly believe that investor has a role to play in this transition. And whether you are an asset management company, whether you are an insurance, whether you are a pension fund, starting to switch your allocation from less fossil fuel, from less brown technologies toward more clean energy, whether it is in equity, whether it is in green bond, whether it is in a non-listed asset, is a good way to send this message to corporates to help them to move in the right direction. And but this means that we need to stop thinking about capital allocation as we used to think in the past, with a strong correlation with indexes, with a low investment in non-listed asset. So this needs a kind of shift in the way we approach investment, but I think it's possible. That's what we try to prove at Mirova. Yeah, that's my main output I think I can give today.
Thank you very much, Ladislas. Thank you for this. Thank you for the two presentations. For those of you watching, don't hesitate to ask your questions now. We have a question about a logistical question. We will send you the presentation if Simon and Michael agree after the webinar. Also, we have a question. Is it true that renewable needs new decentralized electricity network? And if that's true, how do we explain that advanced economies, countries who do invest in solar and wind doesn't invest much in network? Do you have a vision of when they need to do so in terms of energetic mix, percentage of renewable, and how much that could represent for a country such France?
Maybe I can kind of kick that off. It seems like a very broad question, but maybe I can just kind of run through some of the issues. I mean, in particular, related to the networks, and maybe and when I say networks, I mean electricity grids. So we use the terms interchangeably. So maybe I can a bit clarify what's going on in some of the advanced economies. So, for example, in the United States, we've actually seen a very strong growth in grid investment over the past 5 years. In Europe, the grid investment has been actually rather stable. And what we see is that in these places where the grid is well established, there's this need to replace and to upgrade old grid infrastructure to make it more resilient and to make it more reliable. So this provides benefits in general for the grids and also the integration of renewables. In some cases, the costs of building grids, for example, laying new transmission lines, has gone up. And so this affects the picture. But what we've seen in general is that advanced economies are doing a pretty good job at scaling up the different parts of the grid, particularly related to the digital parts. So the integration of smart meters, advanced distribution infrastructure, automation, sometimes EV charging. So increasing this responsiveness, this two-way responsiveness of the grid, which, even though the headline number for grid investment hasn't gone up by that much, this digital portion has gone up. So this enables the integration of more renewables at the decentralized level, but it also enables the better functioning of the centralized grid in general. When we're looking at going forward, the requirements for grid investment, a lot of these requirements are, of course, benefiting from these investments in digital technologies and smaller scale technologies, but a lot of the renewables, most of the renewables being built in the future are still utility scale, solar PV, wind, hydropower. Offshore wind is an excellent example of this, where in a report we did last year on offshore wind and our World Energy Outlook, we looked at the very large potential for offshore wind in Europe. This provides very stable or relatively high stable capacity factors compared to onshore wind and solar PV. But the grid investments and the integration investment, or the infrastructure investments associated with this are huge. And so there you need reliable models from the transmission system operators to fund grid investments, particularly to fund the connections to the shore. And this is where there can be a number of challenges related to the licensing, the permitting, who pays for the different grid investments. And so I think these types of challenges, and these are very much regulatory challenges, as opposed to necessarily being just pure investment or technology challenges. These are the types of challenges which are being wrestled at the country level, particularly when it comes to the portions of the consumer bills and how much those fixed charges are, which fund these investments in the grid. So I would sort of point to that as being a major issue going forward, in addition to sustaining investment in the sort of decentralized part, which enables the real-time operation of the grid.
Maybe one thought on that. Well, every time you build a renewable energy project in Europe, of course, you connect it to the grid, so you bring some kind of a decentralization of the network anytime you bring this new capacity to the network. I think there is a kind of question underneath that is also the way that renewable energy are compatible with other kind of energy in terms of energy mix. That was part of the question. So of course, the issue with renewable energy is the fact that they are not providing electricity all the time. So if you have no wind or no sun, what is happening, and you need some backup capacity. So it has been, you have a part of your question is with a strong focus on France. I've seen many comments in France saying that nuclear was not compatible with renewable energy because renewable nuclear energy was kind of providing very stable production. And that if you want to bring some new renewable capacity, then you will need to develop some gas power plant, for instance, to absorb the variability of the electricity production coming from renewable. Actually, this is not what is happening, and what we see now is that, and even during the crisis, is that nuclear capacity has been able to adapt the production according to the production of renewable wind turbines or solar plants. And actually, using some prospection tools, we see that engineers from EDF are now able to adapt the capacity of nuclear plants to face the variability of renewable energy. So the kind of issue that we might fear that renewable energy might not fit within the current infrastructure, I think that we are talking about blackout due to expansion of renewable in Europe for decades. Well, in countries like Germany or Denmark, where the share of renewable is very high today, we have not seen anything like that. I'm not saying that it's easy. Of course, we have connection with other countries which helps, but overall, we managed to do this integration quite smoothly.
Okay, thank you very much. Another question, could the demand mix given by the WHO scenario be used as a target proxy for financial portfolio mix?
Do you want to answer, Michael, or should I jump in?
I mean, I would be very impressed if it could be. I think there's a number of challenges in translating, you know, how much energy, total primary energy demand is met by coal, by oil, by renewables into a financial portfolio. But I guess I'd be very interested to hear the investor perspective on that one.
So on our side, well, from the kind of information we get from the IEA, we have so the WEO scenarios, which are in terms of energy mix. And then you have the prospect coming from the World Energy Investment Outlook, which gives in 2030, 2040, 2050, the kind of investment breakdown we need by type of energy. So in coal, in gas, in renewable, etc. The issue with this kind of figures is that the amount of investment in terms of capex, so the kind of money that the companies are going to invest to develop the new capacities. When you speak about a portfolio, a financial portfolio, it's not exactly the same thing because you are looking at investment in equity. If you are looking at an equity portfolio or investment in debt through a debt portfolio, for non-listed assets, it might be different again. Still, at Mirova, what we do is what we try to do is to assess whether we believe our portfolio is to degree compatible or not, and to assess this kind of alignment or non-alignment, we use the energy outlook investment to have a rough idea of how much investment you need to do in brown technology, how much investment you need to do in clean technology. I think I've seen that some members of 2 Degrees Investing are in the room. And so for me, even if it's not a rocket science, very precise thing, taking this kind of rough idea of how much you need to decrease investment in fossil fuel and how much you need to expand investment in renewable energy, in clean technology, in energy efficiency, give you an idea of how much you need to shift your financial portfolio to be 2 degree compatible. And for me, even if it's not very precise and very exact, you can use this kind of scenario to help you to build a more sustainable financial portfolio mix.
So one thing that I would just add to that is that as we look out over the scenarios that we're talking about in the World Energy Outlook and in others, it's going to be increasingly important to not just look at the supply side of the energy mix, but the question was asked through the lens of demand, and actually the distinctions between different types of energy demand in terms of not just whether it is transport or industry or buildings, but precisely which type of industrial players have the cleaner processes, which type of transport we want to encourage is going to become increasingly important. And I think that there are in some ways much bigger challenges in terms of allocating portfolios within these distinctions inside different energy demand sectors. And there's a lot of really interesting work, I think, to be done there. I mean, a lot of the sustainable finance workers come up with metrics for looking at whether something can be classified as green in efficiency and things, but they've mostly so far really focused on the kind of the black and white cases. And we've got some analysis in the investment report for the first time, looking at what it means to be issuing transition bonds and some of these new financial instruments as well.
Maybe one additional thought is the idea that when you speak about a financial portfolio mix, well, when you see the kind of requirement we have on the clean technologies and the kind of investment asset that we can invest in the listed area, an investor might quickly face some issues in terms of, well, I cannot invest as much as I would like to do in green energy if I stay in the listed area. And I think this kind of thinking leads to the idea that there is a need for the diversification toward well, new kind of asset.
Yeah, I mean, not to prolong the question, but I think it's a really important point. I mean, we found that it is very difficult to find, and I'm sure you find that it's very difficult to find sort of pure play listed equities to invest in the clean energy space. They just don't have the kind of scale or the liquidity often that institutional investors are looking for. And I guess an interesting question for us, also sort of piggybacking on the comment on industries and transition, is you have a number of, for example, oil and gas companies, something we wrote a report about at the beginning of this year, who have taken differentiated strategies in terms of looking at their own emissions goals and their energy portfolio going forward, and whether it makes sense from an investor point of view to be able to invest in an oil and gas company like Equinor, like Shell, or what kind of differences in financial performance or cost of capital may be associated with these companies versus the Exxons or the ConocoPhillips of the world who are maybe doing relatively less. So I think, the vast majority of the industries in the world probably don't fall into necessarily a neat category of brown or green. And so understanding how to allocate capital to those industries and make those kind of fine distinctions, like you said, outside of the indices, I think would be a very important question and sort of line of analysis going forward. And hopefully we can better kind of link or make available the types of detail that would be needed in IEA products to be able to facilitate that type of analysis.
No more comments? Thank you very much. Maybe we can go back to the issue of emerging countries. We have a question, what about investments in renewable energies in developing countries? Are they resilient as well? Are these countries still attractive?
Well, when we're looking at the numbers in terms of what we expect for 2020, we actually see more of a hit or more of a risk to an investment decline in renewables in the emerging economies relative to the advanced economies. So this is putting China aside because China is its own market. This is coming from a couple of directions, but one of which is the policy signals that we've seen. So for example, countries like Brazil and Mexico have suspended or put on sort of indefinite hold some of their auctions for new renewable capacity, for new transmission capacity. We have still seen progress in India in terms of auctioning renewables, but we see a lot more uncertainty related to the financial viability of state-owned utilities who, as Simon said in the ownership slide, are very important off-takers for renewables, and their credit worthiness really affect the investment case for renewables. So in general, there's a lot of questions around the financial health of state-owned actors who are crucial nodes as a sort of counterparties for renewable investments. And for this reason, we've made an estimate or made expectations where we think actually renewables will be less resilient in developing countries compared to advanced economies. But that said, renewables are still more resilient in these countries compared to the fossil fuel sector.
Maybe one comment. Well, indeed, when you look at the issue of, if you take electricity first, well, we are seeing, I think, the energy transition happening in most OECD countries, where the share of renewable is rising sharply and the share of coal is declining. Well, coal is one of the biggest issues. We have to phase out most coal plants in the next decades quite quickly, and where most coal plants are existing in China and in other developing countries. So developing low carbon energy in a developing country is a key aspect of the energy transition. So what do? You can develop either renewable energy or nuclear power plant to switch from a CO2 intensive electricity production model towards a more low carbon electricity model. Regarding nuclear, I don't think this is the place to debate that, but clearly I'm not sure that all developing countries will have some strong enough technological skills to develop this kind of energy. So there is a big question about how to develop more renewable energies in developing countries. From an investor's perspective, especially for European or US investors, investing in developing countries is always a tricky issue, both due to country risk fund issues or due to forex issues. What we have done on the natural capital side, where we are quite developed on developing country, is trying to push for blended finance. This idea that there might be something between private investment and fully public investment, where you create some kind of financial structure where you have several investors, the public investors taking the higher risk part of the portfolio, and then some private investors taking the other part of the portfolio, which help to use in an efficient manner some public funds without using only subsidies. But the issue is that many times private investors won't go to developing countries alone, and having this kind of having this kind of public buffer to help them, to reassure them about the quality of the investment and the fact that they will not face the strong loss if there is any, even if, as you say, Michael, renewables are quite resilient even in developing countries. Having this kind of financial structure help to develop the market, and I think that's something we need to push forward much more in the future.
Yeah, I think a lot of development banks recognize that they can play a very sort of counter-cyclical role in the crisis. It's uncertain to me how much they're focused on expanding their project pipelines as opposed to kind of servicing their existing portfolios. We've heard some different signals there, and there also are signals from governments, particularly with Europe and the European Investment Bank, trying to align or sort of deploy those balance sheets in a manner that to take on more risk or to provide risk capital. But how much that affects some of the developing countries, I think, is something that we'll see play itself out. And here as well, I think the provision of guarantees by development finance institutions, I think, will be an important sort of feature of this, in addition to the blended finance aspect that you say regarding loans.
Thank you very much. Thank you. Time flies, so at the end of the webinar. Thank you very much for all these presentations and debates. If you have questions, we can send you answers by email. I invite you already to our next webinars on the 17th about the role of financial regulation, the low carbon transition, on the 19th about the ESG data and innovation, the 1st of July with Alain Grandjean and Benoît Leguet on sustainable finance news. Thank you to our speakers. Thank you very much, and I wish you a great day.
Thank you very much.
Thank you very much.
Thank you for organizing. Thanks, everybody.
Bye-bye.
Bye-bye.
Bye-bye.